Hello everyone, I'm Ray Sheen and I'll be spending some time with you today talking about top 10 tips for finance, and we're focused at the fundamental level on finance. This is not a class for or a webinar for finance professionals. This is a webinar for business people. My background is one that I worked in government agencies for a number of years. I then worked for General Electric for a number of years, and for the last 20 years I've been doing teaching and consulting in management and business practices, including along the way writing a couple of books associated with dealing with finance, but it's always been from a business perspective. I'm not an accountant, I'm not a financial professional, I'm a business leader who has to speak the language of money, because that's the language of business. And so what I want to do with you today is share some of these best practices, some of these tips for how you can communicate what's happening in your part of your organization, communicate that in financial terms, and be able to explain what's happening and understand what other folks are doing and what they're talking about. One thing I would like to ask is that if you have questions, please go ahead and send those to Cecilia. She will share those at the end of the class or the end of the webinar, and that's when we will then answer all of those questions. So please send those to her. Well, let's get started. As I mentioned, there's top 10 tips here, and these 10 tips are going to be ones that are used to not only talk about the finance from the finances, working with the financial reporting, but also some tips about how to actually just deal with your budgets and variances and making good decisions with money along the way. So rather than spending a lot of time on this slide, what I'd like to do is dig right into the first tip. And the first one is this idea of timing. Timing versus amount on any financial transaction. Both of those are important. In fact, they are equally important. We're often used to thinking of finances in terms of the amount. How many thousands of dollars or how many euros or how much money are you going to be spending? But equally important is the time, the date. Our financial systems are time-dependent systems, and so based upon the date that is associated with that transaction will determine whether or not that transaction is in one financial statement or another financial statement. It'll determine when you have to report it and when you have to talk about it. Timing issues often create major problems for companies if they have been setting expectations about certain amounts of revenue or costs, and then because of timing, things are a little bit early or a little bit late within the financial report that they have coming up, that money is not going to move. That's not going to, those transactions don't happen. Then it becomes an appearance that the company has lost control. That's why we many times are going to be focusing, well, not many times, I'm always focusing every bit as much on the timing as I am on the amount. And just an interesting element of the tip associated with this is that the timing is usually much easier for us to manage than the amount. As we work through what day things will happen and when we will actually have a transaction occur. I'm reminded of a project I was running one time. I had a fairly large purchase that I was going to be making from a supplier. By fairly large, in this case, it was several $1,000,000 worth of equipment that we were purchasing. I had my supplier structure the deliveries so that they could deliver, and my deliveries were going to be happening near the end of our fiscal year. So I had the supplier structure the deliveries to deliver half during the last week of the fiscal year and the second half during the first week of this next fiscal year. And I then put in a clause into the contract that said that I could move either one of those by 1 week at no penalty. Well, what that gave me the ability to do was that as we neared year end, I went to my finance folks and said, if you need an extra $1,000,000 of spending in this year, I can bring it in, no penalties, no cost, and it's something I need. Or if you want me to delay spending by $1,000,000, I can push it out, again, at no penalty, and it won't impact my project. I gave them $1,000,000 of flexibility to help them manage the reports. They were now my friends. And incidentally, it's good to have finance as a friend. You've probably been in a situation where as you came up near the end of the quarter or end of a year, you've been told, don't spend money. You can't travel. We can't do anything until the new year starts. Or maybe the opposite situation where you've been told spend money. Use it or lose it. Spend that money now. And that's because the money has that date stamp on it. At financial transaction, the timing transaction is just as important as the amount. In order for that to fit into the correct financial statement, we have to have the right stamp. So as I said, timing, easier to manage than the amount. You will be asked to manage that frequently, so be aware that that's always coming. Well, let's move on to the next one. By the way, if you're hearing some strange noise, where I am right now, we're having a thunderstorm with a hailstorm going on. Hopefully I won't lose power. But we do, if you're hearing some rumbling in the background, it's the thunder and the hail. Okay, the next thing I want to talk about is the earnings statement, one of the 3 financial reports, and the keys here for what's important on the earnings statement. You're often going to be asked to explain what's happening and to explain your portion of what's going on in the financial statement. Now there's 4 key lines that I want us to focus on. The first one is the total revenue. How much money that came in? How much sales did we actually have? Total revenue is an important piece because that's the money we will then have to work with. The next line I want to do is go down to the one that says gross profit, about halfway down. Well, for everything that we sell, whether that's a product or a service, we have to actually make the product or deliver the service. And there's costs associated with making that product or delivering that service. We subtract out those costs, and what we have is now gross profit, sometimes referred to as gross margin. That gross profit or gross margin number is a sense of how much money we're making on each sale after we subtract the cost of just doing the work of the sale itself. The next line to look at is operating profit. And now notice between gross profit and operating profit, I've got operating expenses. Those are all the costs of running the business. That's the cost of your utilities. That's the cost of your finance department and your IT department. That's the cost of keeping the building going, keeping the lights on. All of that run the business costs. Those costs continue. Whether I sell a lot or little, I'm still going to have those operating costs. And so I have to subtract out the value of those operating costs from the gross profit that I've received, and now that gets me to an operating profit. Operating profit often is the most important measure for an operating manager because an operating manager can control everything above that line, at least through the way they sell, the way they build stuff, and how they run the business, and everything below the line is controlled by finance. Below that line then we have interest expense associated with debt and the taxes that we have to deal with. That gets us to finally the bottom line. The final results, the net income, sometimes referred to as profit or earnings. You'll hear all of those terms used interchangeably. Everything else in that financial statement, or the earnings statement, is meant to explain those 4 lines. And those 4 lines, though, are important for us because often we're asked the question, so how'd you do? Did you make money? Well, did we make money depends upon which line the person who's asking the question is focused on. Do they want to know, did we get money in? That's the revenue line. Do they want to know, are our products profitable? Well, that's the gross profit line. Do they want to know, is the business operating well? That's the operating expense or the operating profit line. Or do they want to know, at the end of the day, as we report to the tax man or to our investors, did we show profit? That's the net income line. Incidentally, the net income, gross profit, and operating profit are often expressed as a ratio over the amount of sales dollars. So you may hear people say that we've got a 15% operating profit or operating margin. That means that 15% of their revenues are operating profit. The other 85% of the revenues are what it takes to run the business. Well, our takeaway tip here is that we need to know what is the issue that the person we're talking with cares about. In order to answer that question, did you make money, we need to know which line is most important to them. Salespeople care about that revenue line. Operations, by that I mean manufacturing or service operations managers, typically look at that gross profit line. The general manager of the business looks at the operating profit line, and the net income line is often then used by finance or investors. Well, let's take a look now at the next financial statement, and that's the balance sheet. The balance sheet, there's going to be 7 key lines that I want us to focus on here. What the balance sheet is showing us is how much money we have tied up in different portions of the business. Now, I put the picture of the balance sheet, the little chart that I have up there, shows assets on one side and liabilities and equity on the other side. And I'm showing that to reflect the purpose of the balance sheet, at least one of those, and why it gets the name balance sheet. The assets will always be equal to the liabilities and equity. The two sides of that chart have to be balanced. By definition, they are always in balance. They're exactly equal. So this is where we want to see, where is the money coming from and going to, where are we using it in our balance sheet. Now, the 7 lines. Well, one important line is, how much cash do you have? How much money do you have sitting in the bank, in a cash account or cash equivalents? You might have, your business might have some stocks or bonds that can be quickly turned into cash. Cash is important because it means I have flexibility. I can immediately make moves. I can do things when I have cash. And many companies look to see, how much cash are you carrying on your books? By the same token, if you have a lot of cash that you're not using for other things, people may ask the question, why aren't you investing it back in the business or distributing it back to your shareholders? So cash is often looked at very closely to determine how much money do you actually have, and are you carrying too much or too little? The next line that I want to point out is accounts receivable. This is money that is owed to us by customers for products or services that have already been delivered to those customers. Now, it's the classic, the check is in the mail. We ship them the product, we've given them the invoice, they're supposed to pay within 30 days, and we're waiting for those 30 days to receive the check. Well, the nice thing about accounts receivable and why it's in this category of a current asset is because we expect that that money will be coming in soon, 30 days or whatever your terms are. So while that's not cash yet, that will become cash very quickly as soon as we receive the payment, as soon as we receive the check. Another current asset is inventory. And this talks about the inventory that is either sellable, meaning it's finished goods inventory, or inventory that is in work to be sold. So we're not talking about the term inventory where some people say, well, you know, we have a fleet of service vans and we have 20 vehicles in our inventory. Well, you're not selling service vans. Your service drivers are driving them. What we would be calling inventory are things you're actually selling, products that are actually going out the door and going to the customer. And the inventory, though, we look at that as money that's on the shelf. Again, it's a current asset because hopefully we'll have a customer who will send in an order today and we'll be able to ship that inventory to them tomorrow, turning that into cash very quickly. But there is, as we all know, sometimes you have slow-moving inventory. You may have some things, some dusty dogs that have been sitting on the shelf for months or even years. That's still called a current asset, even though you'll probably never be able to sell it for your money's worth. Inventory is another place where we can have money locked up. On the asset side, it looks good from an asset standpoint, but the bad part is that's money that I don't have available for other things because it's all locked up in the inventory. Now, the fourth line I want to look at is the total fixed assets. So the sum of all those, that's the money that's in the ground, in the building, the equipment, and that money, over time, we depreciate that because we use up the value of the equipment. We use up the building. The building gets run down and has to be repaired. So that fixed asset, if we don't do anything else, will shrink over time, representing that it's being used up. But it's the money that we're investing in the business, and it's a fixed asset, so it's going to be there for future years. So it's a longer-term investment. Facilities and equipment are the two primary categories there. The fifth line I want to talk about is debt. Now, we often will look at both short-term and long-term debt, and the finance people care about that, and investors care about that because short-term debt has to be paid right away, and they want to look at your current assets to make sure you can pay your short-term debt. But total debt is also a big important element because it shows how much money we owe to other people. What is does the business have enough money to be able to continue to pay its bills, to be able to pay its ongoing debt servicing? So that's looking at that total amount of debt, and that debt is often viewed as a total and looked in a ratio in terms of debt to equity or debt to assets, as we look to see how much debt we have in the business. The fifth line I have there is total liabilities. Now, total liabilities includes debt, but it also includes all the other money that we owe. And again, an investor or a manager wants to see how much money do we owe, because they want to know that we definitely can keep the business going, that we'll be able to pay our creditors. The last line to talk about is total equity. Equity is money that we've received from our investors, either through their initial stock, or it's money that the business has reinvested back into the company. And that would be the retained earnings. That would be earnings that we use to reinvest, to plow back into the business. Again, we're looking here to see, really, in most cases, what we're looking at is the ratio of equity and liabilities, and how much equity do we have versus how much liabilities do we have, and try to understand how is the business created its asset base. Did it borrow all the money to get there, or did it earn or get investors to give it the money to build the asset base? Again, often these are shown as ratios normally over the net income. So you'll hear terms like return on assets, return on equity, return on liabilities, return on debt. The takeaway here, our tip: know where your money is and know where it's going. Are our inventories growing? Are our receivables shrinking? What's happening? Is our debt increasing or decreasing, especially as a percentage of our asset base? So know where your money is and where it's going. Well, the third financial statement is the cash flow statement. And the cash flow statement, think of that as really, in many respects, it's kind of like the business's wallet or checkbook. The money that's coming in and going out, how's it flowing through the business? There are 4 key lines that I want to highlight on this. And those 4 key lines are the total cash from operating activities. That means cash from just running the business, from just doing our day-to-day sales, making the product, and keeping the business going. And so notice that within that category, it starts with the net income, how much money we made, but then it looks at some efficiency ratios or efficiency elements, which would be things like changes in receivables, changes in our payables, the money we owe to our suppliers, or changes in inventory. And those are shown as both plus or minus, because depending upon what's happening in the business, I may have used up a bunch of cash making a lot of inventory, or I may have sold off a lot of inventory and in that case freed up a lot of cash, generated cash. So it could be either pluses or minuses depending upon how efficiently the business was operating. The next line is cash from investing activities. And so this will be, what changes do we have in our assets, our investment in our facilities and our equipment. And it would include changes in any financial assets that we might have. Normally, though, this is going to be where we're looking at how the business is investing in where the investments are going, what kind of investments that we're making. And then the third line is cash from financing activities. This involves getting money in the financial markets, either through debt, going down to the bank and borrowing money, or paying off a loan, or it could be getting money through stock, issuing stock, or doing a stock buyback and recovering stock. Also, it includes the dividends paid out to the stockholders, the shareholders. The last line then is net cash flow. And the question we look at here is, throughout the year, at the end of the year, is there more money in the company's wallet than there was at the beginning of the year or during the time period, the month or quarter that we're looking at? And we look to see where that money came from and where it went. Did we make money through our operations? Did we make money through our financing? Did we spend a lot of money on investing or on just running the business? Where are we spending money? Are we investing in the business or are we harvesting the business? Did we try to borrow our way to prosperity or have we earned our way to prosperity? Where's the money coming from and where it is going? And that leads us to our tip in this area. When you look at your cash flow statement, you get a great sense of what the true business strategy is, because that's where we see what we're actually spending our money on. Where did we spend our money? Where are we actually getting our money? The real strategy is revealed, not what's in the wonderful statements that are released to the press or the great PowerPoint pitches, but what are we really doing? That shows up in the cash flow statement, and that's why in many companies what you'll hear the term is cash is king, because they want to make sure that the cash is doing what we really want it to do. We actually are running our business in order to make cash to keep us profitable, rather to keep us viable, so that we have enough money to continue to pay our bills, to continue to keep the business going. Well, that's enough on financial statements. Let's move now more into some of the operating kinds of activities. And the first thing I want to do is talk about return on investment. Now, return on investment, or ROI, as it's the acronym it goes by, is just an analysis of all the costs and all the benefits that are associated with a particular activity or set of activities that the business is going to do. Now, there's a lot of different ways to calculate return on investment. There's both static and dynamic methods. In fact, in our courses on the GoSkill courses on finance, which I believe you've got a special on that right now, so you may want to take a look at that. We go through the 4 primary dynamic ways of doing return on investment, and that's with a payback period, which gives us our answer in time, break even, which gives us our answer in terms of how many units we have to sell, net present value, which gives us our answer in terms of how much money we will make, and the internal rate of return, which is giving us more like an interest rate view of the investment. Whichever method your finance folks tell you to use it. They all work well. They all have strengths, all have weaknesses. But when you're doing your return on investment calculation, the keys here is to make sure that you've got all of the right benefits and costs included. When you're including your costs, think not only the upfront costs or the project costs of what it takes to create this new capability, and that would be the people on the project or any equipment that you might have to purchase. Could also include any cost of capital if you have to borrow money to do the work. But also think about any ongoing costs that we're adding to the business. We now have new equipment that has to be maintained and calibrated. We have to have 3 more people in this department now to manage the calls that will be coming in and the work associated with this new capability. All of those are costs that need to be included in your ROI calculation. But you also need to make sure you include all of the benefits and make sure that you've monetized them. Now, what do I mean by that? Well, obviously, on one hand, you've got the benefits of, if this project creates new sales, we've got the new sales revenue. Don't forget, though, you've also got the cost of making the new product. So really, the revenue you're getting is that gross profit line that we talked about earlier. And so, because you have extra cost of building the product in addition to the sales of selling it. You may also have some reductions in some of your operating costs. So maybe I can get rid of some old equipment that was very difficult to maintain and very expensive. I may be able to eliminate a department that we're no longer using and be able to free up the costs associated of running that particular group or that department. So there may be some savings. And when I say monetize those, in some cases the benefits are soft benefits. We've got improved employee morale or greater customer satisfaction. To monetize those, you have to determine what changes would we see in behavior. So with improved morale, well, maybe we have less turnover, and so we can see a reduction in hiring costs. And improved customer satisfaction, maybe we have better retention, and so we can have lower marketing and sales costs. Whatever it is, we need to capture all of those costs and put them into that return on investment calculation, which leads us then to the tip that we have here. Years ago, I was working in an organization and I had a manager who, whenever we'd start to do a return on investment calculation, he would always come back and he'd say, the answer to here is that you've got to show me a positive return. And his favorite phrase was to use, if the cash don't flow, the answer is no. If you can't show that by doing this this new idea that you've got, that at the end of the day it's going to give us a return, it's going to give us more benefits than cost, the answer is no, we're not going to do it. As much as you might like the idea, it has to make money at the end of the day for us. Well, with that, let's move on to our next one, which is talking about budgets. Budgets are things that we just have to deal with. Many of us don't particularly like budgets, but that's an element of doing business, is managing budgets. And a key to remember about a budget is it's a way of showing what you intend to do. A budget is an estimate of what you will spend your money on in the future. Now, we use it to help us make sure that we are not overspending or underspending somewhere, that it gives us a guidance, but it is based upon a future guess, and so it's going to be full of assumptions and constraints, and some of those will undoubtedly be wrong. So you hardly ever achieve your budget precisely. It's a good starting point, and it reveals your intentions, but it's not what's actually going to happen. So if you miss your budget, that in and of itself is not bad, as long as you know why you missed your budget and there was a good reason for that. But let's talk a little bit about putting budgets together and what budgets mean. A top-down budget is management's strategic intent of how you should spend your money, what you should be working on, where we want you to focus your activities. The bottom-up budget is the operational intent of what we think it's going to take to do the work you've asked us to do. And when we're doing budgeting, often we look at both of those, and sometimes they're close and sometimes they're very different. If there are major disconnects, it's often based upon a very different set of assumptions or constraints. And that's going to lead us to our key tip here. When you're trying to figure out budgets, and you're wondering, well, how am I going to budget for this activity? What am I going to do there? Don't debate the numbers with your team or with management. Instead, debate the assumptions and constraints. So if management says, well, I think we should be spending $100,000 on this activity, and you said, well, I thought we were going to be spending $1 million on that activity, what's the different assumptions? How many people did you think it was going to take to do that? What did you think you would have to purchase? And ask management, how many people did they think it would take to do that? And what did they think would have to be purchased? Focus on what the activities are and the assumptions and constraints around those activities. Once those are agreed to, you often find that the agreeing on the numbers are then very easy. We can quickly nail down what the number. Once we've all agreed we're going to have to hire 3 new people, well, then it's just a matter of figuring out what our hiring costs and what the average salary is going to be. That part is usually pretty easy to work with. The bigger difficulty is, are we going to hire 3 people or 30 people to do this work? So again, budgeting, focus on assumptions and constraints. The numbers will then usually work out for themselves pretty easily. Well, let's continue on in this theme of budgeting, but I want to get a little bit deeper now into how we actually do estimates and estimating and the enablers for good estimates. That's one of the most difficult elements of a budget that many people tell me is that, well, I know our categories, but I don't know how to estimate how much money we're going to spend. I don't know what it's really going to cost, so I don't know what I should have as my estimate for that particular category. Well, estimates are based upon a combination of experience and uncertainty. Where you have experience, you can rely on that experience and estimate very accurately. I've been down this road. I know how much money it takes to do this work. I know what's going to be required. I know how much activity we have. Think of it as when you do your morning commute to work. You can estimate how long it's going to take. If you've been going to the same place for the last year, you know what it takes. But that first week or two, you don't really know. Okay, what's traffic going to be like? Are there going to be any delays along the way? Is there public transportation? We're still sorting things out because we don't know. It's the uncertainty that leads to a lot of the challenges in our estimating. And so what I want to do is try to collapse that uncertainty to make it as small as possible. So when you're estimating, first divide out the uncertainty. Categorize that, determine what are the things I don't know, put those in a box. And for the things that I do know, I can quickly put together the estimates because we've been down that path, we have the data, we have the experience. For those things then where we don't know, the uncertain areas, now what you want to do is start testing some assumptions. Which assumptions will matter? Which assumptions could make a big difference on what that estimate, on what the actual turns out to be? And then I can determine which assumptions are going to be the most important ones, and I can try to work on those to clarify them as quickly as I can, or to at least try to get as much additional experience from the wise heads in the organization who have been down the path with that. And by testing assumptions, I'm talking about clarifying the kind of work that's going to be done, who's going to do it, what resources are available that we can work with, and what do we have to go out and purchase or procure. Rely on experience. Using your own experience if you have it. If you don't have your own experience, then look for somebody with gray hair or no hair and ask them. They probably have the experience, they've seen it before, and leverage that experience on those things that are uncertain. So our takeaway tip here is that we want to extrapolate the known. The things that we know, work from that, and that's the part that we can estimate accurately. But at the end of the day, we're going to have to guess the unknowns. One other suggestion for you on that in guessing the unknowns, also document the assumptions that you worked with, so that later on, when it turns out that you missed the number badly, and you probably will miss a few of them badly, you can at least explain why. You can say, we thought that we were going to be able to get this work done with 3 tests. And it turns out we actually had to go through 7 tests to get there. We had all these tests, the extra tests we had to do that hadn't been in the plan, they weren't in the budget. You can at least explain why based upon the original assumptions as compared to what actually happened. Well, we're making good progress on our tips. Let me move on to the next one, and I want to talk now a little about reserves and buffers. If you haven't heard that term before, a reserve is just a set of money that's been set aside to handle whatever is unknown, unexpected, or undefined at this point in time. And sometimes we call those buffers, sometimes reserves. At the end of the day, I don't care what you call it. The point is that it's the ability to respond to the unexpected. When you go on your vacations, I don't know about you, but at least what I'll often do is I'll have a little bit of money that's the walking around money in my pocket for the unexpected things. If I want to buy something, if I want to do something, it wasn't in the plan, but I do plan that there will be something that is unplanned that I'll spend money on. And so I'll always have a little bit of money in reserve for that. We use these reserves to address the uncertainty in our estimates. Think back to the previous slide when I was talking about estimating. You want to put together on your estimate your best guess. Don't use worst case. Don't use best case. Use what you think is the most likely. When I say the best guess, that's by that I mean the most likely case. But then keep a reserve around to handle whatever uncertainty is out there. Incidentally, the reason you don't want to give your worst estimate and put that right in your budget is because if you have the money there, it will definitely be spent. So instead, I put in a more likely, not worst case, but just a more likely value in my budget, and I hold some money back in a reserve. Now we can keep that reserve, we can budget it in several ways. One way that it gets reserved or budgeted is with a management reserve account. Now in this case, that means that senior management, or if you are a senior manager, you keep a separate pot of money, a reserve account, and you use that to handle whatever unexpected things happen, whatever risk happens along the way. Now, for those of you who are not the senior managers, if you want to get the money, well, now you have to go begging, asking for the money. Mother, may I please spend money on this? So you have to get into that begging mode, justifying where you're spending money. Although it does let management have clear control over how that money gets spent. Another technique, and one that I actually prefer, is a purposed reserve account. And this we actually use many times in maintenance. So let's think back to our previous slide on estimating our maintenance activities for the year. We have some equipment we have to maintain. Do we know what's going to break down? No. Now I can estimate with accuracy what my routine maintenance is, the amount of ongoing routine maintenance. I'm going to be using up a certain amount of consumables that I can budget based upon what we've been spending for the last few years. But what if we have a big breakdown? I don't know about that. I can't anticipate where that is. But I do have a reserve account that would handle maintenance breakdowns. I don't need to have one for each machine. Instead, I have one account that would cover a breakdown on whatever machine happens to break down this year. Don't know which one will be, but I have a maintenance account, a reserve account that is a purposeful account to be able to handle the unexpected items within that category. And I often see this in the area of failure analysis, maintenance work, customer service, customer repairs. This is where I often see people having these types of accounts. They don't know what they'll be doing at the beginning of the year, but they know that there will likely be something, so they have an account for it. The third way you can do reserves or buffers is you can embed that reserve in the actual estimate of the activity that you're talking about. Now, you may have heard that phrase that when you're estimating, that people pad their estimates. Well, I never pad my estimates. Never, ever, ever should you pad your estimates. But it is appropriate to risk mitigate your estimates. And I'm not just playing names or playing games with words there. What I mean by risk mitigating your estimate is you look at that and you say, well, I do think the most likely amount of money it's going to take to do this work is $100,000. But there is some uncertainty there, and in order to be able to cover that uncertainty, well, I'm going to risk mitigate that by having an extra $10,000 that I hold aside in a reserve account for that activity. Again, it's a purposed reserve account, but usually in a case like that, we don't put that as a separate line item in the budget. We still tie it to that same activity, but it's more than what we authorize the team to spend initially, so we have some money there to work with. You can use any of these techniques. They all work well. The key tip here is that the size of your reserve reflects the amount of risk that you're dealing with. The greater the risk, the greater the reserve. You may have heard that phrase, greater the risk, the greater the reward. Well, in budgeting, the greater the risk, the greater the reserve. Don't go forward with a budget that has, or an activity that has high risk and no reserve in it, because that's just guaranteeing you're going to miss your numbers badly. So instead, have your reserve, share what those values are with management, let them know what you're doing and how you're working with it, but make sure you've buffered the risk in your planning. Okay, well, that's enough with our budgeting and estimating. Let's move now into a different section of dealing with finance, and that's variance. Dealing with the fact that the amount of money that I've actually spent was different than what was in my budget. And what I want to talk about here are the drivers of variance. If you understand why the variance occurred, then you'll know if the variance is a problem for the business or not. And there's three different ways in which a variance will occur. One way a variance will occur is if the resource rate, the resource variance, the resource rate is different than you had initially planned. We had planned on this activity, we're going to be using some of our most seasoned and senior professionals to get the work done, and oh, by the way, we pay them quite a bit of money. But it turns out the person doing the work was the summer intern, and we don't pay them very much at all. So I've got a big underrun on that particular activity. Well, I may have a big underrun. That underrun will likely stay in place. That will be a permanent underrun, because if the summer intern completed the activity, I'm not going to go back and spend more money on it again. It's done, and so it's done at that. By the same token, if I spend a higher cost resource to do an activity that was budgeted for a low cost resource, well, now that's going to be an overrun that's going to be there because that work was done with a high cost resource. That's a permanent variance, underrun or overrun. The next type of variance is a scope variance. And this is where the work turned out to be either more work or less work than what we had planned. More than what was in the initial budget, in the initial estimates. So back to my earlier example, we had planned to have to go through 3 tests. It actually took us 7 tests. Well, that's going to be a permanent overrun because our scope expanded to be 7 tests instead of 3. When you have a scope variance, that variance is permanent. And sometimes it is a permanent underrun. If it turns out we descope something, we save that money. We don't have to spend that money. The third type of variance is one that often is only a temporary variance and will go away as time works its way out, and that's a schedule variance. And what we mean by that is that you've done something in a different time period than what it was originally planned. Recall I said that every financial transaction has a timestamp on it. And when you did your budgeting and estimating, you had to estimate a timestamp for when you would be spending the money. If you spend the money in a different period, in a different month, or a different quarter, well, it's going to show an underrun or an overrun variance in the quarter in which it happened and in the quarter in which it was budgeted. Now, those things will typically cancel each other out. We didn't do it in the month of March when we planned. Instead, we're going to do it in April. Well, it's going to be an underrun in March, an overrun in April, but by May, the variance has gone away because we've now done the activity and spent the money we intended to spend on it. Incidentally, one comment about when you're going through these variances, try to understand what's really happening. Variance analysis is not a blame game. We're not trying to pin the blame on somebody. We're trying to understand what has happened so we'll know if this is a permanent variance or a temporary variance, and we do that so we can manage our expectations and management's expectations of where the money is going to be spent. Remember, they've got to do those financial reports that we looked at in our first few tips, and those are going to be shared publicly, so they need to understand what's happening so that they're prepared for everything that's going to be going in there. And that gets us then to our tip in this area. Know why the variance occurred. Variances aren't all equal. Some are permanent, but some are temporary. And that means that you might have a temporary good variance that goes away, or a temporary bad variance that gets better. You need to know what that is so you don't set false expectations because of those variances. Keep in mind, finance just sees the total number. And so they see a number and they don't know if things are good or bad. In fact, one of the things that can be really fooling for you is that you might be having offsetting variances. So let's say I'm doing that extra testing that I'm talking about, and so I'm adding scopes. I've got an extra cost, but at the same time I'm not doing some other activities. They got delayed, so I'm not spending those in the month we planned. So finance looks at the total amount of spending for that month and says, oh, that's right where it should be. Well, actually, I've got a temporary underrun that's going to go away, and I've got a permanent overrun that will finally become exposed. And so I need to let finance know in time so that they can be prepared for that. Okay, well, we're making good progress. Let's get to our last tip now, and that's that financial reports are the business reality. We talked about the financial reports in the first few tips, and once again, if you need to know more about financial reports or you're uncomfortable reading those, the GoSkills finance courses, spend time on those and really go through them in more depth, and we focus on what those mean and what each of the lines are, and how you as an operating manager or a project manager or business leader can influence each of those numbers. Well, the financial statements are going to be pulled from the information that's in the financial system. That's why we need to load good budgets into the system. We have to have reasonable estimates. And we need to make sure that we're recording the correct values of what we're spending and when we're spending it. That date is just as important as the amount, because those financial reports are going to be used then to make business decisions. Finance leaders, both internal and external business leaders, will be looking at those and making decisions about your business. Do we have money to spend? Do we not have money to spend? Can we make an investment? Can we do a purchase? Or do we need to stop what we're doing and lay people off or shut down an operation? Those will be based upon the numbers in the financial system, so you need to make sure that they're accurate and reflect what's really happening. The financial reports are used by external agencies for compliance purposes, and I'm thinking there in particular taxing organizations. They go through those, and you pay taxes based on what's in the financial report. So you need to, once again, make sure those are accurate so that you're paying the correct amounts. We don't want to overpay, but we don't want to underpay either. We want to pay what's correct and what's legal. And finally, those financial records become the historic records of the business. That's what actually has happened in the business, and so that's going to be what we look back to gaining experience for our estimates in the future. As we look at previous experience, as we look at what's happened in the past, where do we go next? It's going to be building off of what's in those financial reports, which brings us then to our final tip. Right or wrong, the financial story is told by those financial records, and it's the financial story is the one that counts for the business. I mentioned at the beginning of this webinar that money, finance, is the language of business. And at the end of the day, business leaders evaluate businesses, evaluate your performance in financial terms. So the financial story for you, for your department, for your project, for your business needs to reflect how well you've managed it and what you've done, and reflect correctly what's happened. That means that you need to be managing your finances well. You don't need to be an accountant. We're not trying to turn you into CPAs, but we want to make sure you understand what's happening in the finances and that you are making good decisions to influence the finances to correctly reflect the good business decisions that I'm sure you're making. Okay, so let's do a quick wrap up of what we have here. In our wrap up, we've got the first: timing is easier to manage than the amount. Timing is just as important as the amount. It's much easier to manage. So think about the dates, think about the timing, and make sure you are managing those dates on your financial transactions. Answering the question, did you make money, depends upon what the person really wants to know. And we were using the earnings statement to answer that. They want to know how much cash came in. They want to know how much each product makes. They want to know what the overall business makes. Or are they looking for what the dividends would be as an investor? Knowing where your money is and where it's going is something that we would understand from the balance sheet. The balance sheet reflects our current financial status. You can think of the balance sheet essentially as the equivalent of your net worth for the business. This is all the assets we have. This is all the money we owe. And it shows where all of your money is. Where is it gone? What's it tied up in? The fourth tip we had was that the strategy is revealed by where you actually spend your money, and that's in that cash flow statement. So understand strategy and make sure you're spending money in accordance with the business strategy, that your spending is aligned with the business's strategic intent. Gets us to number 5. Now when we're deciding what to spend money on, that old saying, if the cash don't flow, the answer is no. The return on investment needs to be positive before we spend money on something. You need to be able to clearly answer whether or not that activity makes money, that project is going to make money, that investment is going to give us cash at the end of the day. Our 6th tip was, don't debate the numbers, debate the assumptions and constraints. You can argue all day over numbers and you'll just be talking past each other. When you have a difference of understanding of assumptions and constraints, you'll never agree on the numbers. So first determine, are we going to hire 3 people or 30 people? Once we know that answer, it'll be much easier to determine how much it's going to cost and how much we're going to pay on those salaries for those individuals. The 7th one, extrapolate the known, but you're going to have to guess the unknown. When you're doing estimating, you want to extrapolate known. Wherever you know something, extrapolate it. So you take the activities you have that you're trying to estimate for, that you're budgeting for, and break those into the 2 categories. What do we know with a high degree of certainty of what we have to do, and what are the unknowns? The things that we know, quickly extrapolate, easy to do. The unknowns are the things that you're going to have to, at the end of the day, guess. Hopefully make an educated guess. Document your assumptions and constraints that go with that guess. 8th one was, the size of the reserve depends upon the size of the risk. The greater the risk, the greater the reserve. Now where that reserve is managed, whether it's at senior management, an account that's set aside as a reserve account, or you embed it in the estimate, I don't care, but you need to have made a conscious decision as to where you have your reserve for the high risk activities that you're responsible for. 9th one, not all variances are equal. Some of them are permanent, some are temporary. You need to understand why a variance occurred so that you can explain to your management and to finance what's going to happen, and they know what to expect in the future. Will the variances go away, or will they be getting bigger as we progress into the future? And our last one, right or wrong, finance story is what happens. It is what happened. It is what counts. Your performance is measured financially. The business's performance is measured financially. You need to understand your financials so that you can affect those to reflect the good job that I'm sure you're doing. Okay, well that wraps up the 10 points, and we still have a few minutes for question and answer, so I'll see if there's any questions that we have at this time.
Hi Ray, yes we do have a couple of questions. The first one is, do you have any suggestions for how to estimate costs for something that you've never done before?
If it's something that we've never done before, there's a couple ways to approach it. One is to say, is there something that's similar to that? We've never done this before, so we've never gone to on a vacation to Rio de Janeiro before. Oh, but we have gone on a vacation to Honolulu. Well, I can take a look at the vacation to Honolulu and try to figure out what of those things might be similar if we went to Rio. So you could try to look at something that might be similar. You can also, at that point, do some literature search. Google it. Find out what other folks have spent, or at least ask some questions on forums. What have other people have experienced who've tried this? At the end of the day, if there's just no way of estimating it, then what I recommend you do is you start to do an incremental tracking. Do a little bit of work, spending some money, a little bit of work, and then say, now what do I know? Essentially, ask yourself the question, what questions do I need to understand? And answer each question at a time, and then based on answering that question, now ask, can I estimate this with more accuracy? Now do I have a clearer picture? As I'm hopefully, with answering each question, I'm being able to move some of the smoke out of my eyes, clear away some of the fog, and get a better view of what's required to get to the end point.
Great. There's another question. How do you know how much of your budget to allocate for different business activities like salaries, product materials, marketing growth, or utilities and monthly bills?
Well, the best place to start on that is with looking at historically what have you spent. But the danger is, if I do it historically, that means I'm going to keep doing things the way we've always done it. So we start off looking historically, but then you ask the question, what has changed? What's different this year as compared to last year? Last year we spent 70% of our budget on salaries. Oh, but this year we're actually going to be bringing in some new equipment. We're not going to need as many people. We're going to have 3 people retiring. We're going to have a lower overall salary cost, and so I'll make the changes based upon what's happened or what I expect to happen during this coming year. So I start with last year's allocation, and then I look at strategically what are we doing differently this year, and how does that change each of those. After I've made those adjustments, then I have my new allocation. Now, once you've got the allocation, you still have to spread it by account. But you start off with that allocation. That's classic budgeting, as we allocate first on our major categories, and then we put it in by account, and finally spread it by month into the actual months that we will be spending the money associated with that particular account.
We have one more question. If we speak about web projects, for example, do you try to estimate the most valuable product first instead of the unknowns and treat all other features as phase 2 and 3, etc.?
Wow, that's a great question, and that depends a little bit on strategy, meaning how your business intends to roll out that product. If the product is a phased product, then that's a very good approach to use. Do the first phase with the things that we know, get stuff out there so we can be building experience. What that does for us is it reduces the uncertainty of the second, third, and fourth phase. And so when I have that, that's great. But when I'm dealing with a product that is something brand new, now we said a web-based product. Well, it might be, we know what the web is, but you may be trying to do something very different on the web than what you've ever done before. And you need to get enough functionality in there to actually start getting experience with that product, to start selling it in the space that you intend to sell it into. So there will undoubtedly be some guesses on that. I do recommend, incidentally, on that with that kind of an approach, use a Scrum-based product development, Agile Scrum product development, which incidentally GoSkills has a course on that also. But use that as your approach, because that will build in through several releases, give you quick feedback on what needs to change, what we can do, and you will also gain experience in the early sprints as to how much it's actually costing to do this development, to do the testing, to get things ready to go. At the end of the day, when you're dealing with something like that, a brand new product in a new market, it's going to be a guess. We can hopefully make it an educated guess, but your guess will probably be wrong. And for that reason, it's always good to have a couple of points along the way that can make some mid-course adjustment, so that at least the final amount of money that we spend is in line with what we expected. But where we're going to spend it, how we're going to allocate that money may change as I make each of those mid-course corrections along the way. Think of it again as you're trying to get to work. First thing you do, at least one of the things that I'll often do, first thing I do is turn on the traffic report. In fact, I'll check the traffic even before I leave the house to know, oh, well, there's been an accident at this intersection, or there's a tie-up out on the interstate. So I can make some mid-course corrections and try to avoid the problems to at least get to work close to on time, if not exactly on time.
Thanks for that answer, Ray. Our last question is, how do you tell if it's less expensive to do something yourself or to outsource it to a supplier or vendor?
Well, that's a great question. Incidentally, that's one that we actually go into quite a bit of detail in the finance courses on, because it's a question that operations managers often are being asked, is the make-buy question. Do we make it ourselves or do we buy it on the outside? Well, just a couple of ground rules for that when you're dealing with that is that that situation is you need to do a cost trade-off. Look at the costs associated with each category and determine which one has the lesser cost, which is the lower cost to the business. But you need to make sure you've included all the costs, not just the direct purchase costs, but also the support costs. I'll use an example. A number of companies a few years ago in the US were outsourcing a lot of their activities to Asia because they could find a lower cost of labor in Asia. But what at least some of the companies found is while that was a lower labor cost, they had a lot more extra support costs, because now they had managers, instead of driving down the street or going across the parking lot for a meeting, they had to hop on an airplane and for a $10,000 airfare to get back and forth to the operation. That it required additional oversight from some of their people in their headquarters operations, since the factory, or now the actual operating location, was so distant, it was hard to communicate, and it just slowed down resolving problems. A lot of extra oversight, and they also found that that they lost the experience of a lot of their experienced operators who'd been doing this work for years. They had a brand new workforce, which, while they're very great people, competent people, they didn't have 20 years of experience doing this work, and so they made a lot more mistakes. And overall, it turned out it cost the company more to outsource, even though it was a lower labor cost, than what it would have cost to keep things in-house. And many of those companies have now been relocating their workforce and trying to move things back into areas that better fit the overall cost to the business. So my comment there is, make sure you've included all appropriate support costs and you've allocated those along with the direct purchase costs that you'd be dealing with.
Great, thanks for that, Ray. Those are all the questions we have.
Great. Well, thanks everybody for coming. I look forward to getting a chance to talk with you again in the future on some other webinar. Bye now.